Do you know why you have exactly how much home and auto insurance you have? Do you know your deductibles, your liability limits? These are questions I'm commonly asking new clients, and typically the answer I get is, well, that's just what the insurance agent told us to get, or that's just what the default options were. So I just want to record an episode today to go through why we have certain liability and deductibles that we're looking at for home and auto insurance, why we target those, just kind of walk you through some things I'd be looking at in a normal policy analysis. It's one of the biggest mistakes I think I see across the board, and one of the lowest hanging pieces of fruit, if you will, in certain situations that we can shop other carriers at least every couple of years. Overall, there's 4 main mistakes that people are making that I see that's commonly across the board. Number 1, low deductibles. So, right, that's deductibles like a windshield or something like that. We have a deductible of $250. That's very common. We're overinsuring ourselves for the small things. Number 2, low liability limits. So this is liability if you hit someone, right? Those limits, they're state limits. Typically, they're about 50,000 or 100,000, and typically we can get those up to 250 or 500,000 on many policies. So low liability. Number 3, coverage not matching the value of the home. So now going kind of into home insurance, or maybe not having an umbrella policy matching your net worth, right? So ensuring that those are accurate. And then number 4, not shopping policies every couple of years. So I can tell you USA is one for sure. If you stay with them, it's not like they give you a discount for staying with them for 24 years. They'll actually raise your premiums. The longer you're with them, they'll just inch them up. Shopping and switching typically allows for some savings. So let's go through each of these briefly and just talk about how to think about these and how to potentially improve your home, auto, and umbrella insurance. Okay, mistake number 1, deductibles being too low. Again, $250 deductibles, very common, $500 deductibles. That will raise your premium. So if I have a low deductible, that means if I have something that happens and it costs $800 and my deductible is $250, right? That means I only pay $250. The insurance company pays the rest. So for that kind of coverage, for the insurance company to say, hey, we're going to cover everything over $250, I'm going to be paying higher premiums, right? Which in the end, if you think about this on a macro level over many years, means the insurance company is going to make more money off me. They would not offer this coverage if it wasn't a win for them. So you're buying more insurance. So this is for small things. Windshield's like the perfect example. Maybe like one hail event, right? Not like hail damaging your entire car and we got to junk it or something, but little things that not only can we cover with cash if we have 3 months of liquidity, we also don't want to make a claim, right? If we go make a claim for a little item and we pay $250 and the insurance company pays $500, that insurance company will likely raise our rates. That's going to show up on our report, right? If we go shop our insurance a year from now, a new insurer, when they're calculating our rate, is going to see that we had a windshield claim or something, right, a year ago. So we don't want to make those claims in the first place. So higher deductibles is one of the things that I see across, honestly, like 80, 90% of policies that come through the door. Typically, I can tell you USAA allows $1,000 deductibles. I know Progressive, because I have the policy myself, allows $2,000 deductibles on cars. So certainly something you'd want to look into. I think also in this, you might not need comprehensive and collision coverage on your vehicle if it's an older car, right? So start to think about like, hey, if I drive myself, I'll tell you, I drive a 2013 Subaru Outback. It's maybe worth 10 grand. I don't drive much at all. That's kind of borderline, but some of these older cars, if something happens to them, we're not necessarily going and fixing that car, if that makes sense. So you may be able to drop some of the comprehensive or collision coverage on your car if it's something that you wouldn't, go get fixed, right? It's not a really nice $50,000 car that we're going to go get fixed up. So anyways, just something to think about there. That's a bit of a longer conversation to make that decision. Okay, mistake number 2, liability limits too low. The liability limits, you'll typically see them as 3 numbers. So bodily injury per person, how much you'd pay, bodily injury per accident, how much the insurance company would pay, and property damage per accident. So a lot of times the state minimums might be $25,000 per person, $50,000 per accident, and $25,000 of property damage per accident. Maybe it's 50, 100. It just depends on what state you're in. This is very inexpensive to raise this to the maximum 250, 500, 100, or 250, 500, 250. It just depends on what carrier you're with. So that would be $250,000 of bodily injury per person, $500,000 of bodily injury per accident, and $100,000 of property damage per accident, 250 of property damage per accident, whatever the maximum is for your carrier. The biggest example I can come with for this is you hit a surgeon that makes $1.4 million a year, and he can't work for 6 months. You damage his hand or something, right? Think about not only the lost salary, but the medical bills, right? So that's kind of the stuff we have to think about. And when we think about raising these from state minimums all the way up to the maximum, we're not talking about crazy amounts of premium. Just to give you ballpark numbers, it might raise your premium, $100 every 6 months, something like that, to get hundreds of thousands of dollars more in coverage. Again, back up for a second. Philosophically, insurance is for the really, really bad things. Really bad. Like you hit a surgeon and you can't work, right? Your house burns down. Not the small things like we cracked our iPhone screen, our windshield got cracked, right? These are little things that we can pay for out of pocket. We can self-insure, lower our insurance costs, and make sure when we're paying insurance premiums, it is for the really bad things like hitting a surgeon. Okay, so with liability limits, also throw in there to have an umbrella policy. So an umbrella policy covers, everyone in your household. Like if you just get sued, generally someone comes over and slips, right? These are like umbrella policy covers is kind of like an umbrella, right, over your net worth. So typically you would have to have the highest liability coverages anyways on your home and auto to have your umbrella policy in place. So typically on a home, that's $500,000 of personal liability. We talked about the auto liability, and then typically a base umbrella policy, it comes with $1 million of coverage. So it's a pretty good recommendation, I'd say, for anyone that has significant assets or net worth. We usually want to cover your net worth with an umbrella policy. They're very inexpensive, $200-300 a year for $1 million of coverage. You can think of yourself as insured. Your house is insured by your home insurance policy, right? So that equity is kind of protected. Your retirement accounts are not touchable as well. So it's really like assets outside of that we really need to be careful about. But I think umbrella policies are so inexpensive, and we live in a very litigious society. So having one of these is kind of a no-brainer as you gain assets and income and net worth. Mistake number 3, I would say this one isn't quite as common, but certainly has become a problem in the last 4 years as real estate values have inflated drastically. But making sure that coverage, especially your homeowners, is covering that replacement value. Like what would it cost to rebuild your home? So when you're looking at that number, you'll probably see it's probably less than the value of your home if you were to go look it up on Zillow. However, you have to understand that your land has value, right? So the actual home is going to be worth less than the property, if that makes sense. If we were going to rebuild this thing, typically insurers are going to increase these because it's going to increase your premium a bit every year. They're going to have a certain replacement cost value in your area. You can go look up. It might be $250 a square foot, right? If you have a custom home or certain items in your home that are custom, that might increase that replacement cost value. But just making sure that does match is certainly something I'd be looking at. Again, not as common of a problem that I'm seeing on policies, but certainly I have seen it. And when we shop it with insurance agents, it is something that they point out, is that these policies need to be increased to account for, the rebuild cost in this area. Okay, last mistake, not shopping your policies around every 2 years, right? So they're going to raise your rates over time. Loyalty does not pay. That you shouldn't feel, I wouldn't feel allegiance to an insurance company. We want it there for the really, really bad things, and we want to use it. But most of the time, hopefully we pay our premiums and never use it, right? Kind of like life insurance, right? We want life insurance so that we pay the premiums and hopefully never use it, and then we're self-insured. So like these insurers, they will jack your rates up. It will happen. Look around. Use an independent agent that can compare multiple providers. This is something I'm doing for my clients every 2 years at a minimum. Really try to do it every year just to give it a good check. So definitely something you can do to save money. I think you'd be shocked if you've never shopped rates before. I can remember when we first got married, we switched from USA to Progressive, right? Like Flow, like the commercial, and we saved about $1,000 every 6 months. It was something crazy. It was like $800 every 6 months. The premium went down. So take a look. There's a couple websites out there. The Zebra's one. You can look on Google, go do some shopping yourself. But make sure you are looking around and not just staying loyal to one company because you like their app or their customer service or something. In summary, 4 mistakes: deductible limits too low, liability limits too low. Those are the big ones, right? Number 3, coverage not matching your home value. And then number 4, just not shopping that policy around. So take action, right? Review your policy, make sure your coverages are good, your deductibles, your liability limits. Shop it around every once in a while. Again, philosophically, insurance for the really, really bad things, not the broken windshields, not the broken iPhone screens, right? We want to protect against house burns down. We hit a surgeon, right? We get sued for $1 million, right? These really, really bad things. That's really well spent money, really well spent insurance premium. I hope that this was helpful. Let me know if you have any questions. Thanks so much for being here, and we will see you in a couple weeks. Thank you for joining us today. Do you want the exact financial planning framework that I use with clients? Go visit baskinfp.com, where you can grab a free download of the ultimate military and veteran financial checklist to give you the bluff on what you need to be doing to manage your finances. We'll be back next week with some more content to help you on your journey to financial freedom. See you then.